If you want to make trade entries like this, then you need to watch this video to the end, because in this video, you will discover a powerful trading strategy that can help you make profitable trades by identifying market reversals. This strategy uses a special tool called the Xtreme Trend Indicator, which helps you understand the market better and make smarter decisions. By paying attention to certain signals, you can know when to buy or sell. Let's start by adding an important tool to our chart called the Xtreme Trend Indicator. This indicator helps us understand the market better and make informed decisions. Look for the Xtreme Trend Indicator developed by Joe DePrasin and add it to our chart. Go to the Style settings and change the 200 EM to white, and that's all for this. Now, let's talk about where this script comes from. It's based on a popular indicator called Half Trend, but with some changes to make it better. Unlike Half Trend, this modified version doesn't change its signals once they appear. It also gives us a more complete view of market trends. What's special about this indicator is that it uses a 200-day moving average. This moving average helps us analyze the market even more. The indicator also tells us when to buy or sell based on the direction of the market price. By using this indicator, we increase our chances of success by focusing on trades that the indicator confirms. Let me explain how this indicator works in more detail. When there's a clear upward or downward trend, we see that the price either goes above or below the 200-day moving average. This tells us it's a good time to make trades. For example, if the price stays above the 200-day moving average, we only look for opportunities to buy. On the other hand, if the price falls below the 200-day moving average, we only consider selling. This clear distinction helps us take advantage of favorable market conditions while reducing risks. It's important to note that this script works really well in markets where there's a clear trend, but sometimes works terribly bad during sideways markets. However, we need to be careful when the price is moving sideways, because relying solely on this indicator for trades during those times could lead to significant losses. To overcome this, we'll combine this indicator with other reliable indicators on TradingView. This way, we can make profitable trades by using a variety of tools that work in different market conditions. Now, let's talk about another tool we'll be using called the Swing High Low Support and Resistance by Pattern Smart. This tool helps us identify levels where prices might bounce back or break through. To set it up, we need to adjust to settings, Swing High Strength and Swing Low Strength, both set to 29. These settings will give us more reliable levels to base our trading decisions on. When we look at the chart, we can see that prices respected these levels before eventually breaking through the support level. When the price breaks below the blue support level, it suggests that the downward trend will continue. On the other hand, when the price breaks above the red resistance level, it indicates that the price will likely keep going up. Now, let's move on to the third indicator, called the Xtreme Trend Reversal by Trendoscope. This indicator is really good at detecting when the price might reverse its direction. When we see a green arrow signal, it means that the price might change from a downward trend to an upward trend. Conversely, when we see a red arrow signal, it suggests that the price might change from an upward trend to a downward trend. However, sometimes we get a reversal signal, but the price doesn't actually reverse. In those cases, we continue to follow the existing trend instead of being misled by the signal. To utilize this strategy effectively, we need to detect those points whereby trending market is likely to reverse, because that will give us the highest achievable profit you need in the market. And the question remains, how do we actually enter trades with this strategy? So, I'll be using the USD JPY in the 3-minute time frame, but you can try out this strategy on other forex pairs as well. Now, for a buy signal to be valid, first, we need to see price action below the 200 moving average, as this shows that price is in a downward trend. Then secondly, I would want to wait till we get a reversal signal from our extreme trend reversal indicator, as this signals that prices are likely to bounce back up. Thirdly, we wait for price action to touch or close below the most recent swing low as indicated by the blue line. When we get all these conditions met, the final confirmation is for us to wait till we get the next blue signal, as this indicates it is time for an upward move. Now make sure that before you enter your trade, the candlestick must have reached this blue line. It can neither touch or close below it. But when we get the blue entry signal, we make sure it is above the recent swing low and not below it, so we can see we got a series of reversal signals at this level. Also notice that when we got our first signal, our second condition for trade entry was at this point, where the candlestick touched the blue swing low level. Again, our entry point was at this point. And we can notice the yellow moving average never changed even while we kept getting reversal signals, and then finally, we got our blue signal. So we only opened one single position at the close of the trigger candlestick where our conditions for entry were met. For the stop loss, we use the recent swing low. And for the take profit level, we aim as high as 2.5 times what was risked in the market. And we see it was successful. You can as well wait till price crosses and closes above the 200 moving average before locking in extra profit. Exactly the opposite is true for a short trade. First, we want to see the price above the 200 moving average. Secondly, we would want to wait to get the red label from the extreme trend reversal indicators, as this indicates the bullish trend is likely to reverse. When we get this signal, we then wait for candlestick to retest the recent swing high. Its retest can either be by touching or closing above the swing high. For the entry to be confirmed, we need to wait for the next yellow label that indicates it's time to sell. When we get our conditions met, we then look towards opening a sell trade at the close of the trigger candlestick. Our stop loss will be at the most recent swing high, and we can aim to achieve as high as 2.5 times what we risked in the market. And we see it was successful. Here is a buy trade you wouldn't have taken, so we can see that we've got a reversal signal for price to go up at this point, and we waited for the candlestick to retrace and touch the swing low level, and from this point, we waited for the next blue signal for a buy entry, but we can see that the signal was not valid, as it lies below the recent swing low, so for this, we would have to avoid this setup. And here is a valid sell signal we would have taken, so we can see we got some couple of reversal signals, and we got a valid swing high level at this point on the chart. And we can note that when we got these signals, price did a retest on this swing high level, and our next yellow signal was at this candlestick, so we therefore enter a short position at this point. Our stop loss and take profit levels remain the same. And we see it was successful. In conclusion, I would say this trading strategy is pretty good. However, if you want to get better results, I would highly suggest you backtest it with the indicators I just showed you. Okay traders, I hope you enjoyed this video. Thanks for watching and see you in the next one.